The Bank of Canada's strategy of raising interest rates is beginning to affect Canadian homeowners, many now being warned to brace for a huge spike in their monthly mortgage payments.
The economy can handle, indeed needs, higher interest rates. And given the unsustainable strength of housing activity, some moderation in housing would be healthy.
And that, of course, is Central Bank Governor Tiff Macklem. He says rising rates will put many new homeowners in a vulnerable financial position. Some could see their regular mortgage payments increase by as much as 30% over the next 5 years. That is also putting off potential home buyers. Take a listen.
If the mortgage goes up by 40%, that's a huge hit to my budget.
The market is not going to correct enough to be able to offset the interest rate difference. So what that leads to is that we're not able to qualify for the home that we want.
Well, for a closer look at this warning by the Bank of Canada and some potential strategies for homeowners, let's now go to Rubina Ahmed-Haq. She's a personal finance columnist, joins us this morning in Oakville, Ontario. Rubina, good morning.
Good morning, Michael.
Listen, let's begin here with your reaction to what we heard from Tiff Macklem, because I think there were many open jaws once they heard what he had to say yesterday.
He's doubling down, making sure that people are prepared for higher interest rates. I mean, he made it pretty clear in the last interest rate announcement when they raised rates for the second time at 2.5% or 50 basis points. And that was already called an oversized rate hike. And now he's basically saying that Canadian mortgage holders, those in debt, need to get ready for higher interest rates because they're coming.
Okay, so the promise that they're coming, but how high are we talking about? How high can they go? How long will those higher rates actually last?
I think we can bake in for sure a 0.5% hike again in July. There are economists that are now also talking about a 0.75% hike. The governor basically saying that he wants to get to about 3% or believes that he needs to get to about 3% overnight lending rate before inflation is going to get under control, because that's really what this conversation is about. They're raising interest rates so they can tamper inflation, which is at a 31-year high. So they need to do something. And one of the tools they have is raising those rates. And so those who have a variable rate mortgage, for example, can expect to pay much higher rates, even 6-7 months from now. And they should be doing their calculations to see what those payments are going to be looking like. Okay, that's variable rate. But I think it's, let's break this down, make it to some news that people can use here and bring up some scenarios. First and foremost, if you're a person who's thinking of buying for the first time, are in a good financial position with low debt, is now a good time to actually get in? So this is a personal decision. Now, if I'm not someone who advises people on their investments individually, but if I was in the market right now for a home, I would take a pause. There's just so much uncertainty right now in the market when it comes to interest rates, when it comes to home prices, when it comes to affordability. And so if you were to take a pause, it would just give you a little bit of time to figure out where exactly you can afford that home and then do all those same calculations you do at any point. Make sure that you can afford that mortgage as if rates were 2, 3, 4, I'm going to even say 5 percentage points higher. If you can still afford to pay those mortgage payments, make those mortgage payments rather, then you can afford that home for the long term. Even if you bought at the top of the market, in 15 years, you're still going to be ahead of someone who didn't buy anything at all. So don't be afraid to get into the market. Just make sure you can afford it for the long term. Okay, now let's bring in another scenario. If you have a mortgage that's up for renewal in a year, what should you be doing? So you should definitely be looking at where interest rates are going. Variable rates have saved historically Canadian home buyers money. So you can keep that information when you are deciding what you want to do. Fixed rates are always higher and they always will cost you more right out of the gate. One strategy some people can use is that they can get a variable rate mortgage, but then pay their mortgage as if they're on a fixed rate. So as if they're on a much higher rate. So they're making those lump sum payments. They're doubling up their payments, making extra payments as much as they're allowed to with the terms of their agreement. And that will help you pay that mortgage down faster because your mortgage is subject to a much lower rate. But these are conversations you should be having with your financial advisor, with your mortgage advisor, to figure out what scenario works best for you. But really, you need to know how much money can you afford every month towards your home and work with that budget rather than trying to find a home and then trying to find the budget to buy that dream home. That's the opposite scenario or the wrong scenario when it comes to buying, especially your first home. So it sounds like that would also be good advice if I'm talking about a 1-year renewal, but what if you're renewing in 2 to 4 years' time? The same suggestion? Yeah, I mean, 2 to 4 years' time, I mean, anything can happen in that much time. A lot of people are worried about whether they should fix their mortgage rates if they're in the variable rate mortgage. Remember, if you're, we're still pretty much at rock bottom. We're not exactly skyrocketing to levels that we've never seen before. We're still, most variable rate mortgages are around 3.5%, which is pretty cheap. Or if you have, for example, a line of credit. And so the best thing you can do is make those lump sum payments, because that immediately brings that principal down. If you go and fix your mortgage, for example, now, because you're worried about where interest rates are going, your payments are immediately going to rise. So bake that in when you make that kind of decision. But if you're not renewing for 2 to 3 years, I wouldn't worry too much. I mean, if you have already set yourself up that you can make those payments, there should be no reason why you can't continue to do so for the next 2 or 3 years until your mortgage renews.
Okay. And what about for everyone else? People who actually don't own property, who cannot get into real estate right now, how should they respond to what we've heard from Tiff Macklin?
Well, their response should be that, eventually this is going to dampen inflation, that prices are going to become more normalized. We're not going to see things like meat rise double digits year over year. So it's going to become a little bit more, not as much shock when we get to the grocery store. Higher interest rates are also for savers. So interest rates on savings accounts go up. So it encourages people to put money into bank accounts for the long term, to put money into fixed income products. So this is good news for those people who are more prudent, who like to save money. And it's also good news for anybody who's in the market to buy their first home, because it's going to cool and normalize those prices a bit. The people I worry the most about is anyone who's bought a home in the last year to 18 months, because they're going to really be feeling the pinch, because they're at the highest end of their mortgage and they're seeing those interest rates only go up.
Rubina, a lot to consider. Thank you for this. Really appreciate it.
Thanks for having me.
That's personal finance columnist Rubina Ahmed-Haq.